Ladies and gentlemen, welcome to the presentation of the inflation report for February 2012. Allow me to introduce the colleagues who produced the inflation report. To my left is Mr. Bojan Marković, Vice Governor of the National Bank of Serbia. Next to him are Mr. Branko Hinić, General Manager of the Monetary Analysis and Statistics Department, and Ms. Snežana Vilaret, Head of the Current Macroeconomic Analysis Division. Sitting on my right side is Mrs. Ljiljana Đurđević, the Inflation Report Director, and at the far left, Mr. Mirko Đukić, Head of the Inflation Projection and Model Development Division. I will now give the floor to Vice Governor Marković, and after that you will have an opportunity to ask questions. Ladies and gentlemen, esteemed members of the press and fellow economists, inflation continued to fall and settled at 7% in December 2011. Consistent with our projections from last year's inflation reports, inflation will return within the target tolerance band already in this quarter. The growth in gross domestic product picked up mildly in the fourth quarter of 2011, but is likely to slow down in the current year due to around 0.5%, mainly due to the prospect of recession in the euro area. In response to subsiding medium-term inflationary pressures, the National Bank of Serbia has cut the key policy rate over the last 9 months by a total of 300 basis points to the current level of 9.5%. The future path of the key policy rate will depend on inflation factors, and in particular on the risks stemming from the international environment and the fiscal policy stance at home. Today, we will present in more detail our view of past macroeconomic developments and our expectations for the period ahead. Public debt crisis in some euro area members is showing signs of abating. Still, in anticipation of a systemic solution that would reassure investors and prevent the contagion, volatility in the financial markets persists, threatening to stall the recovery of the euro area economy and to slow growth at global level. In such an environment, international prices of most primary commodities continued to fall moderately, with the exceptions of oil and other energy products, which edged up in the fourth quarter amid political tensions in the Persian Gulf. Economic activity indicators point to a fall in the euro area's GDP in the fourth quarter, and based on the latest forecasts, that tendency is likely to persist in 2012. Growth forecasts for countries in the region, which are Serbia's important trade partners, have also been revised down. These developments triggered a further rise in Serbia's risk premium in the last quarter of 2011. And though the risk premium, measured by the Emerging Markets Bond Index, receded mildly since the beginning of the year, it is currently by around 160 basis points higher than in mid-2011. As a result, at the end of January, the dinar was around 5% weaker vis-à-vis the euro than at the end of the third quarter of 2011. However, compared to regional peers under a similar exchange rate regime, the dinar exchange rate was more stable during the last year, indicating that Serbia's financial resilience to external shocks is somewhat greater than in earlier years. A recent increase in the foreign exchange market volatility was not accompanied by the drop in liquidity. To the contrary, over the last few days, trading volumes at the interbank foreign exchange market averaged around 130 million per day, which shows that the foreign exchange market is operating smoothly. The National Bank of Serbia remains committed to intervening in the foreign exchange market in the event of excessive daily volatility and low trading volumes. Any central bank intervention to defend the level of the exchange rate would render foreign exchange cheaper for those with poor foreign exchange liquidity management, as well as short-term investors leaving the country, and all of this at the expense of Serbia's foreign exchange reserves. This would encourage risky short-term investors and reduce the inherent stability of the Serbian financial market, which is contrary to the objectives of the National Bank and a disincentive for long-term investors. Nevertheless, let me reiterate that the National Bank will do everything necessary to prevent any excessive short-term fluctuations and to ensure stability of the foreign exchange market. Foreign exchange reserves in the amount of 11.6 billion euros are more than a sufficient guarantee of our capacity to do so. Keeping the fiscal budget for 2012 within the framework agreed earlier with the International Monetary Fund would help strengthen the country's financial and macroeconomic stability. It would provide an additional assurance to foreign investors that the Serbian authorities are running a responsible and sustainable macroeconomic policy, which would lead to lower country risk premium and bring the cost of borrowing down. Unfavorable movements in the international environment have already reflected on the Serbian economy in the last 3 quarters, though a modest pickup was registered by the end of the last year. Serbia's GDP is estimated to have increased in the 4th quarter of 2011 by 0.8% relative to the same period a year earlier, and by 0.3% relative to the quarter before. The most significant contribution came from investment activity, which is reflected in the robust growth in imports of equipment in the 4th quarter. Consistent with retail trade movements, final consumption rose modestly, remaining subdued compared to previous years. This is due primarily to the rise in unemployment over the past 3 years, which, according to the results of the last labour force survey, stood at 23.7 in November 2011. Foreign trade expanded in late 2011, though with imports outpacing exports. Encouraging, however, is that imports of equipment and intermediate goods grew faster than imports of consumer goods. Robust growth in imports of equipment and intermediate goods in the 4th quarter was the main reason for the higher-than-expected current account deficit in 2011, which came at 9.1% of GDP. On the side of exports, growth was driven mainly by processed food and chemical products, while exports of agricultural products were on the decline in the 4th quarter, due primarily to low river levels, river flows being a major route for the agricultural product exports. The deteriorated growth outlook of our key foreign trade partners and Smederevo Steel Factory, ex-US Steel, losing its private owner, were the key reasons behind the National Bank of Serbia's downward revision of the GDP growth forecast for 2012 to 0.5% from 1.5%. As a reminder, the GDP growth projection in the November inflation report assumed economic stagnation in the euro area in 2012, but implied higher downside risks due to the assessment of a significant probability of the euro area slipping into recession. The new GDP growth projection assumes a recession, that is, a 0.5% fall in economic activity of the euro area. But this time, the risks to the projection are judged to be evenly balanced. Developments in the international environment will weigh primarily on demand for our export products and the inflow of foreign direct investments. Despite the expected contraction in export demand, some of the investments made and those underway in export-oriented industries, primarily automotive, will begin to reflect on output and export figures in this and the following year. However, the departure of the private owner of Smederevo Steel Factory signals muted prospects for the exports of base metals. The economy as a whole is likely to see a modest increase in exports this year, while stronger growth may be expected only with the recovery of external demand.
S obzirom na visoku stopu nezaposlenosti I skroman projektovani privredni rast, I ove godine očekujemo pad finalne potrošnje.
Given the high unemployment rate and modest economic growth forecast, we expect that final consumption will fall this year again. This, together with lower investment demand, will reflect in a drop in imports. A more visible recovery of the Serbian economy may be expected only in 2013, conditioned largely on how the global growth dynamics plays out. We wish to underline again that sustainability of economic growth in Serbia is more important than its pace, which assumes further shifting of the sources of growth from domestic final consumption towards net exports and investments, primarily into export-oriented industries. A downward trend in year-on-year inflation, in place since last May, continued, driven primarily by the weakening of the cost-push pressure on food prices and low aggregate demand. Monetary policy mitigated successfully the increase in inflation expectations and thus the spillover from food price growth to other prices by lifting the key policy rate in late 2010 and early 2011. The fourth quarter saw consumer prices rising 0.6%, while their year-on-year growth eased down from 9.3% in September to 7% in December. The key contribution to the decline in inflation in that quarter came from food prices again. Growth in fruit and vegetable prices fell short of what would be a typical hike for that time of the year, while processed food prices declined through cheapening of their inputs such as wheat and corn. Market-determined prices of non-food products and services also grew more moderately than in the third quarter. This component of the consumer price index, which is most persistent and most responsive to monetary policy measures, has moved within the target tolerance band practically ever since the inflation targeting regime was introduced in Serbia. As far as administered prices are concerned, the only significant hikes in the fourth quarter were recorded for natural gas and heating, but their contribution to headline inflation was modest. Nevertheless, due to the high growth in the first half of the year, administered prices exceeded the growth framework planned for 2011. Year-on-year inflation is expected to continue down, that is, to return within the target tolerance band already in this quarter, which confirms our projections from last year's inflation reports. Medium term, it is expected to remain within the target tolerance band, with occasional oscillations. The government's decree imposing a 10% restriction on trade margins on some food products led to their cheapening in January, but as the decree expires in July, these prices could bounce back. However, provided that primary agricultural commodities see no considerable hikes in the coming period, the prices of processed food will probably rise at a somewhat slower rate than those of non-food products. On the other hand, fruit and vegetable prices will probably outpace other prices in 2012. In view of their sharp fall in the season behind us, fruit and vegetable prices are estimated to be rather low currently, and are hence likely to rise even in the event of an average agricultural performance. We expect the contribution of fruit and vegetable prices to inflation growth to be most pronounced in the second quarter, with the onset of a new agricultural season. Looking forward, growth in administered prices is likely to be slower than in earlier years, as they have come closer to an economically sustainable level. Their growth in 2012 will probably be modest until the formation of new republic and local authorities, but could catch up thereafter in the second half of the year. A rise in import prices, prompted by the weakening of the dinar, may put pressure on domestic prices. We estimate, however, that real marginal costs of net importers are still relatively low, and that importers will be able to offset a major part of the growth in import costs by cutting their margins. Given the high unemployment rate and deteriorated outlook for economic growth at home and abroad, the disinflationary pressures stemming from low aggregate demand will persist over the coming period as well. A disinflationary effect will also be generated by inflation expectations. In the fourth quarter, they dropped to 6% from 8%. In light of a further decline in inflationary pressures, the downward tendency in inflation expectations is likely to continue this year. A decline in year-on-year inflation will be pronounced in the first months of 2012 as high price hikes from early 2011 drop out of its calculation. As a result, inflation will return within the target tolerance band already in this quarter. Year-on-year inflation will reach its minimum level in March or April, when it should move around the lower bound of the target tolerance band. However, with the onset of a new agricultural season, higher growth in administered prices after elections, and the repeal of the decree limiting trade margins, inflation will return towards the target by the third quarter 2012. On account of these factors, in the first half of 2013, year-on-year inflation may temporarily stand at around the upper bound of the target tolerance band, only to return towards the 4 ± 1.5% target thereafter. The key risks to the presented projection relate mostly to the international environment and fiscal policy at home. Outlook for Serbia's economic growth and pressures on inflation will largely depend on developments in the euro area, given that its members, together with countries in our region, are our major foreign trade partners. The speed and way of resolving the public debt crisis in some member states, as well as economic activity in the euro area, may, in addition to demand for our export products, also impact the country risk premium movements. Under the latest indicators, the economic downturn in the euro area in 2012 may be softer than the assumed 0.5%, though deviations are possible in both directions. Fiscal policy will also have a significant impact on the perception of country risk. Mounting public debt and a more significant deviation of the 2012 budget from the framework agreed earlier with the IMF may have inflationary consequences through rising risk premium, depreciation pressures and higher demand, which would leave less scope for monetary policy easing. In response to subsiding inflationary pressures, the National Bank of Serbia has cut the key policy rate over the last 9 months by a total 300 basis points to its current level of 9.5%. In February, the key policy rate was left unchanged. The future path of the key policy rate will depend on materialization of inflation factors, while developments in the international environment and fiscal policy at home remain the key risks. We wish to remind that the decline in inflation to around the lower bound of the target tolerance band, which may happen in some months of the first half of the year, would be only temporary and, as such, would not be the reason for monetary policy response. Given the time lag in reaction of the key policy rate on inflation, monetary policy should not respond to temporary factors, but to factors with a medium-term effect on inflation. Ladies and gentlemen, recent developments in some countries in the region show that in the current situation, financial markets are highly sensitive to any disruption in macroeconomic and financial stability. Therefore, the best way for the government and the central bank to contribute to the improvement in the economic environment is to pursue a policy which ensures long-term macroeconomic stability. Such policy implies a sustainable level of public debt, price stability over the medium term, and a stable and resilient financial system. Any attempt at stimulating the economy in an unsustainable way could jeopardize the achievement of the above objectives, which would elevate the country risk and increase the cost of borrowing, exacerbate the business environment, and ultimately inflict damage to the economy it was intended to help. The National Bank of Serbia will therefore continue to stabilize inflation at a low level and maintain a sound financial system, which, in our opinion, is the best way to help the economy in the given circumstances. The more the fiscal budget developments are aligned with the framework earlier agreed with the IMF, the more attainable will be the achievement of these objectives with more stimulative monetary policy.
Thank you, Vice Governor. Ladies and gentlemen, the floor is yours. I would just kindly ask you to introduce yourselves before asking the question. Miladin Kovacevic from the Serbian Statistical Office. I have two comments and several questions. I will try to keep it as short as possible. The first one concerns prices. Have you got any forecast for the first quarter this year? I will give you our forecast by the Macroeconomic Trends magazine. We think that inflation will amount to 2.1% because there will be a kind of contraction on the supply side. We think that these winter conditions can significantly affect inflation movements, especially movements of agricultural product prices. What do you think about this seasonal effect and about the reduced supply of primarily agricultural products by the end of the first quarter? If our forecast comes true, we could then hardly talk about keeping inflation within the target in the longer run. The second question is about one of the Vice Governor's comments regarding administered prices, that is, about administered prices reaching the parity level. What we do know is that electricity prices are still at a level that is at disparity, and we know that the increase in electricity prices has a strong and rather distributed effect within the system of prices. In the current situation, we are facing electricity shortages, not only because of the harsh winter, but also because of production deficits. According to a World Bank study, by 2015, we will have these deficits in electricity production, and the implication is that we would have to increase electricity prices relatively soon, and by 20 to 40%, or at least this is what the World Bank study says. The third and most important question I wanted to ask concerns a note on page 27 of the February inflation report, where it is said that talks within the Vienna Initiative too have begun in circumstances different from those surrounding the first Vienna Initiative. And the circumstances we are talking about are bank deleveraging in advanced European economies and a concurrent harmonization with Basel II or Basel III standards. Basel III, I think. Analysts from the Macroeconomic Analysis Trends magazine, myself included, see 5 main reasons which make the contraction of the balance of payments rather likely during this year. The first is quite obviously the US deal. The second reason is the mentioned deleveraging of European banks. The third reason is the country risk premium, also cited in the report as one of the stronger risks. The fourth reason is the increase in debt amortization, both commercial and private, and this is clearly seen in the National Bank of Serbia's publication on debt. And the fifth reason is the reduced inflow of trade credits. The inflow of these credits was substantial last year, but can hardly be expected to remain at the level recorded in 2011. So these are the 5 reasons we envisage contraction in the balance of payments in 2012. Maintaining the objectives of economic and monetary policies and the projected 0.5% economic growth, which was significantly lowered relative to the previous projection, requires a greater use of the FX reserves. What I want to say is that greater use of foreign exchange reserves must be included in your assumptions. According to our estimates, the minimum price, that is, cost, would be around 2 billion euros. So that would be the minimum decrease in foreign exchange reserves, the minimum quota of foreign exchange reserves. But what's more important, in my opinion, and a strategic issue for the National Bank, is forecasting the forthcoming contraction in the balance of payments. That is, a contraction on the financial and capital accounts of the balance of payments on the one hand, and on the other hand, a kind of a calibration procedure or policy for foreign exchange reserves management, as foreign exchange reserves are bound to become an increasingly important factor over the next 3 to 4 years in the given circumstances. And the fourth comment, which could contribute to optimism, though it yet remains to be seen to what extent the trend will persist. Namely, last year the drop in employment in legal entities did not exceed 10,000, compared to 2010 when it measured 25,000, and in 2009 when it measured 50,000. What I'm trying to say is that the dynamics of job losses is slowing, and irrespective of the high unemployment rate, retaining employment at the same level in 2012 can be considered a success for Serbia. Thank you, Miladin. There are quite a few questions here. I will ask Mr. Hinic and Mr. Dukic to comment on our inflation projection and inflation growth in the first quarter this year. But allow me to try to answer some of Miladin's questions in more detail first. I can only repeat that according to our inflation projection, in the first quarter inflation will be subject to certain temporary factors, and I would like to refer you in this respect to text box 1 on page 10 of the inflation report, which explains the temporary factors and their impact on inflation. The factors include some methodological changes in the calculation of prices of some seasonal products. The effect of these factors will be felt until May and are therefore considered temporary. The National Bank of Serbia's position is more than clear in this respect. Monetary policy should not respond to temporary factors, because 9 to 12 months elapse from the moment the National Bank responds by the key policy rate until the time the maximum effect of such a move comes through. Let me conclude. We will not respond to the things happening in the next 2 to 3 months. We are sure that by the start of the new agricultural season, the temporary inflation drop to around the lower bound of the target tolerance band will have been smoothed out. So in this context, we will not respond with the key policy rate to these temporary factors, but we will respond in case of any factors with a longer-term effect on inflation. As regards administered prices, we did not say that they have come, but rather approached an economically sustainable level. I would like to remind you that in the past several years, we have had much stronger growth in administered prices than in other prices. In 2009, the administered price growth target was set at 11 plus minus 2% and was slightly exceeded, while the inflation target was set at 8 plus minus 2%. This means that if administered prices were supposed to go up by 11 plus minus 2% and overall prices by 8 plus minus 2%, non-administered prices were supposed to go up by significantly less than the said 8 plus minus 2%. In 2010, the administered price growth was planned at 9 plus minus 2% and the inflation target was set at 6 plus minus 2%. In 2011, the administered price growth was planned at 7 plus minus 2% and the inflation target was set at 4.5 plus minus 1.5%. So in each of these years, administered prices grew faster than non-administered prices, and this is why a significant part of the disparity between the prices we have had and the economically sustainable level is lower. The need for reducing the disparity is waning, though this does not mean that the disparity has been eliminated fully. As for capital inflows and the sources of funding, last year we had had most of the factors you've mentioned, and still there was no greater need for the National Bank's interventions from foreign exchange reserves. This is because the need for interventions will be determined depending on inflows. It does not depend only on how exports and imports play out, but also on the volume of foreign direct investment and portfolio investments we managed to attract in 2012. And this depends on long-term macroeconomic stability. Should it be assessed that long-term macroeconomic situation in Serbia is sustainable, The volume of foreign direct investment and portfolio investments will be higher, which will enable us to close the balance of payments gap. Another important thing, and we have some optimism when it comes to this point, though there are plenty of reasons for caution too, is that in the last 2 years the structure of external financing has changed significantly. Namely, the domestic sources of funding increased. And let me remind you, at the end of 2008, household savings stood at 4.8 billion euros. Now they are standing at their historical high of 7.6 billion euros, meaning that we have nearly 3 billion euros more in the domestic sources of funding. On the other hand, the efficiency of using domestic sources of financing has also increased thanks to the development of the market of dinar securities. Development of the dinar market of securities enables a more efficient promotion of the existing domestic sources of funding. When talking about foreign sources of funding, the structure also improved compared to 2 or 3 years ago. For the better, of course. First, we have a somewhat greater share of funding coming from international financial institutions, notably European Investment Bank and the European Bank for Reconstruction and Development. In January 2010, IFIs financed the Serbian banking sector with around 450 billion euros. And now this financing is over 1.1 billion. So effectively, the financing from IFIs has more than doubled. This is very important because these sources of financing are usually long-term and offered at much more favorable interest rates compared to other sources of external financing. What is also very important is that when we take a look at the maturity structure of external sources of financing of the Serbian banking sector, they are much longer term than they used to be in 2010. In January 2010, 45% of external sources of financing was short-term, whereas now short-term sources account for not more than 21% of the total external sources of financing. The maturity structure has shifted, and any such maturity shift reassures us that there may be no faster or dramatic outflows of financing. Though these are good news, we should not be lulled in by them. We should be cautious. The quantity needed for potential intervention or the absence of intervention will depend primarily on the size of inflows of foreign direct and portfolio investments, which in turn depend on the assessment of long-term macroeconomic stability in Serbia. Perhaps someone will say something about inflation in the first quarter of the year. Our projection is quite clear when it comes to the growth in the first quarter. As you said, there are many factors that could affect inflation movements, but as you know, the projection is shown as a range and not as a central point, because deviations are possible. But the reason we say that year-on-year inflation will return within the target tolerance band in the first quarter is that the high monthly inflation rates recorded in early 2010-11 will drop out of its calculation. So 5.5% was the consumer price growth in the first quarter of 2011. This is a bit of a technical explanation, but thank you. Mirjana Brajković, RTS. I would like to go back to Mr. Kovacevic's question. The question was, to what extent will the bad winter conditions reflect on economic movements in the country, considering that the companies are closing down because of low temperatures and inability of their employees to come to work. And there have also been some announcements of floods. You also say that many people criticize the National Bank of Serbia that it has not intervened sufficiently in the foreign exchange market. And that this is the reason why the exchange rate has weakened. Who was the who are the profit makers of the weaker exchange rate? Who did you target by this message? I would now ask Mr. Hinic to answer this question, and I think that many people are interested in this answer. I will add to what Mr. Kovacevic said. I guess he's interested in the extent to which reduced supply and increased production costs could affect inflation over the coming period. Basically, this has been included as a risk under our projection and is supposed to reflect during the second quarter of the year as the new agricultural season kicks in, that is in May. So the pressure, there will be pressure, most probably, because these extremely low temperatures persisting over a longer period of time will lead to an increase in the production costs. And at the same time, we can expect somewhat lower supply, which will lead to a higher increase in prices. But all of this has been covered by our projection. When it comes to total agricultural products, not only fruit and vegetables, primary agricultural commodities, wheat and corn. Of course, corn is still not sown, so we cannot say what is expected, but experts say that sown surfaces under wheat and they say that these crops are protected from the harsh winter conditions and that the expected yields are not threatened. Of course, you said that floods are possible, but it remains to be seen whether they will happen or not. This could jeopardize the sown surfaces, but also the future crops. Thank you. Thank you, Branko. I will now go back to your second question regarding the exchange rate, since this appears to be a highly interesting topic. I will try to give you a more concrete, more specific answer. The National Bank of Serbia's intervention strategy has been the way it should be and the way it was proclaimed. I will again explain to you the situations in which the National Bank of Serbia intervenes in the foreign exchange market. Allow me to talk about the exchange rate in more detail, about the exchange rate, long-term exchange rate, medium-term exchange rate, and short-term exchange rate, because these movements differ. When we're talking about long-term exchange rate movements, next 2, 3, 4, or 5 years, according to the MBS experts, the real exchange rate, and this is what we follow and monitor and what's important for the National Bank of Serbia, nominal exchange rate adjusted by inflation. The real exchange rate is at its long-term trend. Perhaps it's somewhat lower than its long-term trend, the real dinar. What is the point of this? The main idea is that in the short term or medium term, the exchange rate may move in either direction. So, and we urge the enterprises and households again, save in the currency you intend to spend and borrow in the currency you receive income. So the movements of the exchange rate are possible in either directions, and they depend on outflows and inflows. But inflows and outflows do not depend only on exports and imports, but also on the inflow of foreign direct investments and portfolio investments. The inflow of foreign direct and portfolio investments depends on the assessment of sustainability of long-term macroeconomic stability in Serbia. So if we continue to adjust growth based on net exports and not on consumption-driven growth, it will be more likely that it's more likely that our macroeconomic stability will be better and that we will have a higher volume of foreign direct and portfolio investments. And now about the exchange rate. In the short term, Over the past several days, we have seen several factors playing a role. We have had somewhat stronger energy imports, but also psychological factors. But in addition to these two factors, we've had poor foreign liquidity management by some domestic companies and the exit of some short-term investors. So these are the investors with certain stop-loss functions. So what am I talking about here? I'm talking about poor foreign liquidity management by some domestic enterprises. Imagine a company which has to pay, for instance, 17 million euros for the sake of imports, in conditions when the Serbian foreign exchange market is quite shallow. The demand of this enterprise for 17 million euros will definitely shake the Serbian foreign exchange market, or it can go in the foreign exchange market for several days, asking for 2 or 3 million euros, which will not disrupt the foreign exchange market. If you have similarly, if you have a short-term investor who has a stop-loss function. I don't know whether you're familiar with this term. This happens when somebody enters a transaction at the level of the exchange rate of 106 dinars per euro, and he expects that the exchange rate will strengthen. But if the dinar, for instance, if the exchange rate rises to 108, the investor wants to get out. So this is stop-loss function. So what can we do when we reach this level of 108 for one or another reason, and when this short-term investor wants to exit the country? If we intervened more heavily with our foreign exchange reserves, we would be taking money from the foreign exchange reserves and putting them into the pocket of that short-term investor. So if the foreign exchange is cheaper, in this way we would allow people with poor foreign exchange liquidity management to buy foreign exchange liquidity cheaper, and all of this at the expense of the National Bank of Serbia's foreign exchange reserves. Of course, these are short-term factors which define the way in which the National Bank of Serbia intervenes in the foreign exchange market. So when is the National Bank of Serbia's intervention justified? It is justified when the trading volumes in the foreign exchange market are low, and depending on the trading volumes, excessive daily volatility will be determined. Sometimes psychological factors also play a role, but this is only the case with short-term volatility. If the trading volumes are rather low, as was the case in 2010, then the volatility below 1% are a signal that that there are certain factors moving and shaking the foreign exchange market. But if the foreign exchange trading volumes are high and the market is functioning smoothly, those people who want to buy foreign exchange can do so. The supply is abundant. We then have to look into what are the factors that are moving the exchange rate, whether they are psychologically induced or whether they are due to poor liquidity management by some players. If the latter, the intervention is less justified, of course, we're always there to stop any excessive movements in the exchange rate and in the foreign exchange market. This was a longer, somewhat longer response, but I think that I managed to explain the character of the National Bank of Serbia's intervention strategy. I repeat that the foreign exchange reserves of the National Bank of Serbia in the amount of 11.6 billion euros are more than a sufficient guarantee of our capacity to do so. I would like to refer you to text box 4. On page 39, this text box covers the optimality of foreign exchange reserves and calculates different levels of foreign exchange reserves that could be considered optimal. So as you can see, the National Bank of Serbia has sufficient foreign exchange reserves to ensure stability of the foreign exchange market and prevent excessive short-term volatility.
Slaviša Čirić from Svetinfo Plus. We know all that, Mr. Markovic, but we have come today to get the answer how the National Bank of Serbia will defend the exchange rate as the exchange rate has destabilized. With what money? On Monday, 70 million euros were spent, if I'm not wrong. So what amount of total foreign exchange reserves will be allocated for the defense of the exchange rate, particularly in the context of reaching or non-reaching the agreement with the IMF? So what you have said right now, we already heard in December. But despite that, the exchange rate has moved. What is the guarantee that this will not happen again? So movements in the exchange rate at this level are not unusual for countries running flexible exchange rates. So the National Bank of Serbia will not defend a trend or a level of the exchange rate. The bank will intervene to prevent excessive daily volatility and to ensure stable and smooth operation of the FX market in Serbia. So foreign exchange reserves of 11.6 billion euros are a sufficient guarantee of the National Bank of Serbia's capacity to do so. Milica Milovanovic, Radio Belgrade. I would like you to explain to us what is a psychological factor. So what is that factor in this case? We heard that from analysts as well. Okay, so again, I will explain to you something about the technique of interventions. It may be a bit more technical. Whenever the exchange rate moves, we at the same time follow many factors. One of the factors is what are the needs for real payments towards residents or non-residents. So non-residents are foreign investors, and residents are domestic enterprises with needs for external payments, and residents also include banks. When we consider what are the payments needed, that is real payments that take place, and if we see that there is a great need for real payments, then it is the indicator that there are no great psychological factors in place. So we can identify increased payments to one or the other, the third segment, which results in a temporary demand-supply mismatch, which is then eliminated by price adjustments. However, in some circumstances, we estimate that there is no very high demand, real demand for payments, but that the exchange rate is, after all, subject to significant volatility. That is the indicator that there are psychological factors or that expectations are created which result in more significant movements in the exchange rate. You have heard the previous questions. So psychological factors may be the following. The exchange rate starts moving in one direction, and some market participants expect that the exchange rate will continue moving in that direction. So that would be an example of a psychological factor. Of course, a good investor would say if the exchange rate is going in one direction, that must mean that it is now underestimated than its long-term trend or sustainability. Of course, that is always an estimate. So let me remind you, we follow quotations from the FX market every half an hour and estimate what is going on in the FX market so as to decide on whether there is a need for the bank's intervention or not. A journalist from B92, how realistic are the assessments of Kirilo Grichenko from the Serbian oil industry NIS that the euro will be worth 117 dinars until the end of the year and that inflation will be 10%? Over the last several years, you could hear different persons assessing the exchange rate. What we do very rarely is to go back and see how realistic were assessments of different people from the previous period. It is hard to assess where the exchange rate will be moving. It is hard to assess not because someone knows little or knows more of macroeconomics, but because it is hard to assess what shocks, as we economists like to say, will happen over the next year. It is hard to assess what will happen in the euro area, how the macroeconomic stability in Serbia will be sustained in the right way. It is hard to assess what will be the post-election dynamics or the dynamics of negotiations with the IMF. It is hard to assess what will be the demand for products of the automotive industry in the world. All this will affect the movements in the exchange rate to a higher or lesser extent. As far as inflation is concerned, again, you know the best, we expect that until the end of 2012, inflation will be within the target tolerance band. Let me remind you, the target for 2012 is 4 plus minus 1.5%. If I understood the Vice Governor well, the National Bank will not defend a trend of the exchange rate, but only excessive volatility. It has already been said in a very precise way what is excessive volatility, and of course it is clear that so far it has been the case. I'm just asking whether I understood you correctly. Defending a trend of the exchange rate is similar to defending a level of the exchange rate. Defending a trend of the exchange rate is what we call a crawling peg. It's a different monetary regime. Our intervention strategy implies the prevention of any excessive daily volatility, and what is very important, the maintenance of stability of the FX market in Serbia, that is the maintenance of trading volumes. What we must not allow is that liquidity dries up in the market, which happened in 2010. It depends on what caused such movement in the exchange rate. So it depends on whether it was caused by psychological factors, real factors, macro fundamentals. It is true that trend movements in the exchange rate sometimes trigger psychological factors, but the reaction to psychological factors is justified, while the reaction to factors such as poor liquidity management is not justified. As far as I understand, it can be caused only by macroeconomic fundamentals. Again, Miladin, I will remind you, the exchange rate is not a trend variable, as we professionally say. It is a variable that should immediately react to the overall future expectation of the trend. Zoran from Tanjug Agency. I have two questions. Have any talks been held between the National Bank of Serbia and the government about a possibly new Vienna initiative that is about the maintenance of exposure of the 10 largest banks in this market, or do you believe that this shouldn't be done right now due to the expected drop in GDP? The second question is, do you expect any negative consequences regarding this strange situation with the IMF? What I have heard is that the country's credit rating could be lowered. Thank you. Thank you, Zoran. Let me start from the second question. Of course, it would be better if the review of the arrangement with the IMF had been successfully concluded, because Serbia's risk premium and its cost of borrowing would probably, in that case, fall significantly, which would leave more scope for stimulation of economic growth through monetary policy easing, and to keep inflation within the set framework at the same time. But what is now important is that the fiscal budget announced by the government is aligned to the greatest possible extent with the framework agreed with the IMF. Let me remind you, the IMF will continue to monitor the economic situation in Serbia. Also, in its press release, the IMF announced a new mission visit in mid-2012. In terms of credit rating, I will remind you that credit rating depends on long-term macroeconomic sustainability. Short-term movements will not result in a change in Serbia's credit rating. However, if long-term macroeconomic stability is jeopardized, then that could mean a danger for the country's credit rating. On the other hand, if there are some structural changes that would imply the improvement in Serbia's long-term macroeconomic stability, then credit rating could even improve. I will remind you that Serbia is a rare country whose credit rating is currently higher than before the crisis. The short-term situation was certainly not the reason for that. The reason, a great reason for that, is Serbia's long-term macroeconomic stability, and such stability was assessed as better than in 2008. As regards your second question, the Vienna Initiative was agreed. It was coordinated among financial system supervisors and banking system supervisors in different countries in the region of Central and Eastern Europe, and countries from which banks most active in that region originate. Also, international financial institutions such as the IMF and EBRD and other institutions also contribute to the Vienna Initiative and its coordination. The character of this Vienna Initiative is slightly different than the previous one. During the first Vienna Initiative, there was a danger whether the whole banking system in Central and Eastern Europe was sustainable, while there were no problems in countries where parent banks come from. The situation is now different, and the question is asked to what extent the situation in countries where parent banks are based is sustainable. Everyone themselves introduces some capital restrictions which will make them competitive for each other and result in the situation when the whole solution is suboptimal for all of them. I'm talking about supervisors in countries where parent banks are based and about supervisors in some Eastern European countries in which such banks operate. What is another important thing is how to ensure that banking sector expansion in some countries does not jeopardize the financial system, so that the expansion should be somehow put under control. I will also remind you that countries that witnessed excessive expansion of the banking system are those countries where the banking system is insufficiently liquid or not profitable. Serbia is one of the countries whose banking system is highly liquid, stable, and what is the most important, profitable, and we expect no major volatility in that regard because banks are still motivated to stay here. A journalist from Bloomberg. How much did the government exceed the budget deficit in late 2011 on the basis of what the IMF said? And what would be the current account deficit in 2012? Because it rose to 9.1% in 2011. And to what extent would these two things make it difficult for you to relax further monetary policy? Or can you already say that you will make a longer pause or even make an end for monetary policy easing? Thank you. The main risks that we have specified relate to fiscal policy and developments in the international environment. So these are the key risks, and their materialization will impact on further movements in the key policy rate. So these are the two things that you mentioned. I would like to ask Ms. Vilaret to present exact data on our projections of the current account deficit for 2012. As regards the first question, the more fiscal policy is expansionary, and the more a greater part of that expansiveness is reflected in consumption rather than in investment, particularly in the export-oriented sector, and the more a larger part of such consumption is financed from external sources, the scope for more relaxed monetary policy will be smaller. I will remind you again that the key policy rate was kept unchanged at 9.5% in February. The movements in these two factors will depend on the capacity of monetary policy to further and more significantly relax the key policy rate. So these two factors are mutually dependent. As regards the share of current account deficit in GDP, According to our projections, this share equaled 9.1% in 2011. But what is more important is to explain the structure of the current account deficit. So if the current account deficit is conditioned by final consumption, which is not the case in our country, then it really represents a problem. We had such a situation in 2008. In 2008, it equaled 21.6% and dropped significantly in 2009. We expect this to happen in 2012. To be more precise, so the current account deficit of 9.1% in 2011 was expected and was due primarily to the significant imports of equipment during the year in export-oriented industries. We expect a decline in the current account deficit due to significant contraction in imports, as we project that 2012 will not see so many investments as in the last year. This can be realistically expected and has been included in our projection for balance of payments for this year as well. 8.4% with a downward tendency, of course, in the coming period. So I'm talking about the share of current account deficit in GDP. So I would like to repeat this thesis. So when we talk about the current account deficit, there is a bad deficit and a good deficit, so to say. So a deficit of only 4% would probably not be sustainable if, on the other hand, such deficit is reflected in higher consumption. So the deficit from 8 to 9%, these are the deficits that we're talking about, can be sustainable if it reflects in investments, notably in net export industries. So to explain the situation, on the example of the Fiat factory. So during the investment cycle in Fiat, we have increased investments, and such increased investments entail the import of equipment. In the period of investment, imports go up and the deficit goes up as well. But the moment when the investment cycle ends, on the one hand, you have a drop in imports because there is no need for a further import of equipment, and on the other hand, you start producing something, in this case cars, and the vast majority of these products are intended for exports. So the moment the investment cycle ends, exports go up and imports go down, and everyone contributes to the growth in net exports. So the current account deficits that are reflected in higher investments in export-oriented industries are good deficits, so to say, while deficits, current account deficits reflected in higher consumption, which we had from 2005 to 2008, could be dubbed bad deficits, because you simply spend those funds and that's it, and this is probably financed by borrowing, and the question is how you will repay that, and on the other hand, you did not boost export capacities and you didn't contribute to longer-term macroeconomic stability and sustainability. Please, if you could explain to us, what attempt of stimulation of the economy in an unsustainable way did you have in mind, and what is the addressee, so to say, of this warning? So many macroeconomic policies are often tempted to try to implement monetary measures in order to create economic growth. I will remind you of Serbia at the beginning of the 90s and the attempt to introduce stronger liquidity in order to stimulate economic growth. All that ended up in hyperinflation. Many other countries also believe that, historically speaking, there are some examples of such countries. They believe that stronger cuts in the key policy rate stronger relaxation of some other monetary policy measures, such as reserve requirements, that it is possible to stimulate economic growth in that way. However, if such stimulation leads to higher inflation rates, the creation of inflation expectations, then we have a risk, a very high risk of entering the inflation spiral. Macroeconomic conditions in which the economy would operate and which would imply two-digit inflation rates or hyperinflation are such that any entrepreneur will find it very hard to operate smoothly. On the other hand, any creation of a two-digit or unsustainable inflation or hyperinflation will also lead to elevation of the country risk premium and higher cost of borrowing, not only for the government but for every enterprise and all of us as individuals. Maintenance of macroeconomic stability, let me repeat, implies a sustainable level of public debt, low and sustainable inflation, and a stable financial system in the country, and all that will reduce the country risk premium and cut the cost of borrowing, not only for the country, for the state as a whole, but for companies and for all of us in general. And to link this to the question from Tanjug, any macroeconomic sustainability would mean a better credit rating for the country, and a better credit rating would imply lower cost of borrowing for the government, companies and individuals. What we can say is that it is important to ensure a stable macroeconomic environment in order to reduce the country risk premium, in which way the cost of borrowing will be reduced for the government, for banks, companies and individuals as well. So we have some time for one more question. So if you could tell us very briefly, we don't have a lot of space in the media. The title of the report is the February inflation report. So you say that in the third quarter, inflation will move within the target tolerance band. So what is the level of inflation in the first 2 months? Has it exceeded the framework set? So in 2011, inflation was above the target tolerance band, and right now it is falling down towards the target tolerance band, and in the first quarter it will be around the lower bound of the target tolerance band, and around the third quarter it will stabilize around the target. The target for 2011 is 4 plus minus 1.5%. Thank you very much.
Dakle, nemamo cifre.
So the National Bank of Serbia does not publish data on inflation. So the Statistical Office publishes data. Data on January inflation will be published on the 22nd or the 23rd of February, and data on February inflation will be published on the 12th of March. Another announcement for all of you. We all witness this inclement weather, but FX markets in Serbia, payment operations in Serbia will operate smoothly on all business days. Thank you. Thank you all very much, and we will see all of you at the presentation of the May inflation report.